Let's start by taking a look at some gold charts. And I believe there's a good chance of it on a technical basis is this current rally, which began after that extreme low of 4,100, breaks through 4,900. Because if we do that, there's really no resistance till about 5,100. The point to reach is going to be to take gold prices over 5,400. And if that happens and it's still sustainable, that's when we'll challenge the new record high. We had a 40% gain in gold compared to a 162% gain in silver. The precious metals are definitely in a rally mode first. Secondly, silver is the proverbial candle lit at both ends, meaning it's burning brighter but lasting twice as long. And the levels that I would like to see is if it does continue to move higher, obviously break above 80, but it's breaking above 90 that really shows the momentum is built because we'll get resistance at $96. Let's start by taking a look at some gold charts. Considering what gold has done, if you look back even a year to date or a year ago, we were looking at much lower numbers. Of course, we've got our line in the sand on the top now. That occurred on the 29th day of January when gold actually topped 5,600. From there, it would make the first of two lows. The first one came in on Monday, the 2nd of February, and gold traded down to about 44.60. Then it made a secondary high, and that's where I'm putting my fib retracement, and I'll explain why in a second. And from there, we had a really, really deep correction. That deep correction took us to about 4,100. That's the 23rd day of March. And from there, gold has been moving higher. If you notice on my chart, I've got a long rectangle, and that rectangle is pretty much surrounding 4,900. That is where I've been looking at technical resistance. Now, it was former support back in the middle of February. The way I was taught and the way I look at support and resistance is they are part and parcel of the same.
Gold is at a critical breaking point right now, and what happens next could shock most investors. After crashing from 5,600 to nearly 4,100 in just weeks, gold is climbing back. But it's running straight into a wall at 4,900. If it breaks through, there's almost no resistance until 5,100, and possibly a run to new all-time highs above 5,400. But here's the twist. Silver is already exploding, up over 160%, massively outperforming gold. So the real question is, are we about to see a massive breakout or a brutal rejection? Let's break it down.
If you're on the second story in your house or in an apartment building and you look down to the ground, that's the floor, and you bang on that floor, that's supporting you. But if you're downstairs on the first level, you look up to your ceiling, it's the same structure. So when you think about support and resistance, realize that at some point, those numbers are support. On the way down, it finds a level at which traders are believing that it's a good price to enter the market, and that will support it because, of course, they'll begin to buy or liquidate short positions. And if it does break below that, as gold did on Wednesday, the 18th of March, closing roughly at 49 and change, and then breaking below, opening the following trading session at about 48.58, and that's where we fell to this extreme low. And so by doing that, we can see that the current recent highs that came in this week, or the challenges, happened right below 4,900. 4,800 is important, but the number I think we need to focus on is 4,900, because that's where gold has been challenged to break above that. The key, though, when we look at gold, and I'll try to pick another chart, okay, where we look at gold, it has moved from the end of October 2025 from 4,000 to 5,600, $1,600 move. When it retraced, the bottom of that retracement is where I mark my 100 or 0 point on the fib level. But the secondary high that we had was a lower high, and then we had a lower low. typically in a market where you get a lower high and lower low is significant in that it could be really anticipating what we call a level of support or resistance that's just been broken. And the one thing that I tend to do to confirm or deny that basic assumption is put up my moving averages. I'm going to do that right now. I've also added the MACD. And so what we can see is that when we look, first of all, at our stochastics, you can see how it dipped and is now below or went below 20. For those unfamiliar with this technique, all a stochastic oscillator is, and we use oscillators and momentum. The oscillator is basically plotting a line comparing the highest high over a certain period to the current high. And so when the stochastics come down like this, it becomes extremely overbought. This is what we saw back in March. You can see where it got very top heavy back in January, and it broke above the 80 and here below the 60. So we've seen a real significant move up on the stochastic. We have also seen that on the MACD, which is simply moving average convergence divergence. We are not quite overbought yet, but we're getting in that territory. When you look at commodities versus stocks, a stock that has been trending higher for a year, even with dips along the way, will consistently be overbought because the price target keeps moving up, that level keeps moving up. We're seeing that in gold, whereas we're not range bound on a longer term basis by any means. We hit an all-time record high. We did get a lower high, then we did get a lower low. What we really need to see, and I believe there's a good chance of it on a technical basis, is this current rally, which began after that extreme low of 4,100, breaks through 4,900, because if we do that, there's really no resistance till about 5,100, and then the basic brass ring, let's say, the point to reach is going to be to take gold prices over 5,400. And if that happens and it's still sustainable, that's when we'll challenge the new record high that came in this year. Much in the same way, when we look at gold and silver, what we've seen is the phenomenal rally end of October. In the case of silver, $46. And by the time it's done climbing, let me just adjust this here. By the time it's done climbing, it's over or close to 120 an ounce. And this happens over 63 bars daily chart, so that means days. And what I want to focus on is the actual percentage gain. 162% gain in gold. It's not quite that good. I mean, if we look at it from the low to the high, we had a 40% gain in gold. That's what I was trying to look at, compared to a 162% gain in silver. So in the case of silver versus gold, the precious metals are definitely in a rally mode first. Secondly, silver is the proverbial candle lit at both ends, meaning it's burning brighter but lasting twice as long. And on the way up during a period of when the precious metals are rallying, what we see is silver outperforming gold by a great deal, 160% to 40% in terms of it. The tact of the actual angle moving up is approximately the same, but it's gaining much more ground as they move to their new all-time record highs, both gold and silver. So what we then saw is typically called an A, B, C correction. That ended on the 23rd day of March with silver opening up at $66. Now, it is still in a rally mode. The levels that I would like to see is if it does continue to move higher, obviously break above 80, but it's breaking above 90 that really shows the momentum is built, because we'll get resistance at $96. That is simply based on this former top. that came in on the second day of March. So 80 is a critical number, but to me, the real critical number to actually take out is right above $89. That would signal the next level, which comes in at 96. And from there, on a technical basis, because of the way it sold off this one day, Friday the 30th of January, and that's a day in which silver opened at 115 and closed at 85. So a huge, huge move. There's no technical resistance above this one top that came in on March 2nd. What we need to see, and I'm just looking back in February, so those numbers would have come in right around 74. That's these bottoms here. The closing price on the 5th of February and opening price on the 6th, those come in just below 70. It's this secondary top. So once again, we get the highest high on record, end of January. From there, we have a tremendously steep correction going from the all-time record high to $64. That's almost halving the price. And if you recall what we witnessed during another major bull run, and this is when gold ran, the middle of 2012 is when it ended, but it ran up to about $1,900 per ounce from about $1,000. It basically doubled.
Let's start with gold. Technically, everything right now revolves around one level, for 1,900. This level used to act as support, but after the March breakdown, it flipped into resistance. And since then, gold has repeatedly failed to reclaim it. That matters because markets don't just move on momentum, they move on conviction. And right now, this level is where big money is deciding whether gold deserves another leg higher. Now, looking at the bigger picture, gold had a massive rally, from 4,000 to 5,600. But then we saw a classic shift in structure, a lower high followed by a lower low. That's typically bearish. However, the rebound from 4,100 shows buyers are still active. Momentum indicators like MACD and stochastics are rising again. But here's the danger. Momentum can look strong, even when price is about to fail. So until gold clearly breaks above 4,900, this rally is still unconfirmed. But if it does break, then the path opens quickly to 5,100, and beyond that, the real target becomes 5,400, the level that could trigger a run at new all-time highs. Now let's talk about silver, because this is where things get really interesting. While gold gained around 40%, silver exploded over 160%. That kind of outperformance usually happens late in a bull cycle, when investors shift from safety to speculation. But it also comes with a warning: volatility. Silver already proved that by crashing from 115 to 64 in a very short time. So now the key levels are clear. 80 equals first breakout signal. 90 equals real confirmation of momentum. 96 equals next major resistance. If silver clears 90, it could move fast. But if it fails, downside can be just as violent. And here's the bigger shift happening across all markets. We're seeing time compression. Moves that used to take years are now happening in weeks. We've seen it in gold, silver, even oil. Massive spikes followed by rapid collapses. That tells us one thing. Markets today are faster, more reactive, and far less forgiving. Which means risk isn't just about direction anymore. It's about speed.
Gold did. Silver was shooting up with it. But we had a multi-year correction after it broke through 1,800. Over a period of about 3 to 4 years, it meandered down till about $1,000 in the middle, the end of 2015. So we had these kinds of moves, these kinds of price gains and price corrections in terms of percentages. We've seen that before. What we've never seen is the compression of time. In other words, what we typically saw take a couple of years to unfold. Back in 2012, when we saw that first peak to 19, a lot of people, including myself, thought it was straight headed to 2000, but it would oscillate between 1900 and 1800, and when it broke 18, it basically fell out of bed. We had a multi-year correction. What I'm seeing in the charts is that we're getting that same kind of momentum, those same huge price differentials or changes where For example, silver running above 120 and then in a short period of time going to 64 would typically be a month long or maybe even a year long correction. Now it's happening in weeks or just about a month. So we've seen a huge acceleration of how quickly price changes over time. That time is compressed, but not necessarily the amount of gains or losses in terms of percentages, especially after you hit new all time record highs. This is when Russia invaded Ukraine. This is when the United States went into Iran. And those are the points in time in which we saw crude oil peak here and then slowly meander from 2022 to January 26th, move from $121 per barrel and then finally settle at around 56. So once again, we saw the price per barrel of crude oil jump and then decline roughly in half. But the halving, let's call it, concluded in January this year and started in March 22. So obviously a multi-year correction. The move was much lower, happened in the 20s. But look at how quickly crude oil spiked from 55 back above 100. And then if I uncompress it, look at how fast it's coming back down. So we're certainly seeing these knee-jerk reactions to the military action that recently occurred. We've seen it before when Russia invaded Ukraine. So we're seeing a very, very similar reaction in crude oil because we are a petro-based society. And so when crude goes from 60 to 120, I'm rounding up and down, and doubles, that increases not only consumer costs for just use of transportation and other things, but companies that are highly dependent get hurt much more than those that are just using to ship a product. We're getting this compression of time in terms of how quickly we see markets move higher or lower. A compression of time that I have never seen, and I've been charting the market since 1985, so a good swath of time. And I've never seen these kinds of moves happen so quickly, both on rallies to the upside as well as corrections to the downside. You can find me at thegoldforecast.com, our YouTube channel, as much as our dedicated website. But in terms of looking at technicals, I was going to pull this before the show. There's a couple of books that are really good. I got my start in candlesticks based on the performance of one of my clients when I was just a broker, a registered representative before I became a CTA or commodity trading advisor, which was my stepping stones to be a market technician. And I saw this gentleman who was an engineer. He wasn't a trader by trade. He was simply working with his pension, hit the bottoms and tops of crude oil, hit the bottoms and tops of grains, hit the bottoms and tops of slow moves in gold. And I asked him, what are you doing that has made your performance excel over some professional traders? I don't see them do as well. And he says, well, I read this book and this book changed my whole strategy about trading. I said, what's the name of it? He says, well, the name of it is The Japanese Chart of Charts. The author is Seiko Shimuzi, and I'm going to send you a copy. So about 3 weeks later, I got a copy of this book, and this is pre-Steve Nissan, Greg Morris, and myself writing books about candlesticks. And it was the translation in the early 90s, 91, 92, of this incredible person talking about the strategies that the Eastern trader uses and the differences between how a Western trader views the market and an Eastern trader. And the key to that is this. When I say that gold gained $25, intrinsically, I'm taking today's closing or settlement price or current price and comparing it to yesterday's settlement price. So the Western trader is very much focused on a close-to-close relationship. It forms a line chart, creates a bar chart, And in a candlestick chart, the only key difference is they draw a rectangle around the open and closing price and paint it in one color if it closes above the open and another color if it closes below.
So here's the bottom line. Gold at 4,900 is the level to watch. Break it, and we could see a powerful rally. Fail, and volatility could take over again. Meanwhile, silver is flashing both opportunity and danger. This is a fast-moving market, and the winners won't be the fastest traders, but the most disciplined ones. If you want more breakdowns like this, where we cut through the noise and focus on what actually matters, make sure to subscribe. Because in this market, timing isn't just important, it's everything.